SMCI and ELF, two of my favorite growth stocks, just crashed after releasing earnings. SMCI dropped 11% in the one day following the earnings, and ELF 35%. Unbelievable. Most investors are panicking. I'm not. I'm buying more. And in this video, I'm going to break down their earnings reports and the trades that I'm putting on now and why I'm putting them on now. So be sure and hit like and subscribe, and let's jump into it. So let's start with Supermicro. They got absolutely punished after earnings. Well, they came in with 35 cents EPS, with the consensus estimate being 46 cents. So they missed by 11 cents. And as far as revenue results, they came in at 5.02 billion with 6.48 billion expected. So that's a $1.47 billion miss, or a negative 15.5% miss. Now, keep in mind, the full fiscal 2025 revenue came in at 21.97 billion. So that's up roughly 46.6% year over year from about 15 billion. So that's still extremely good growth. Now, let's touch on a couple of the highlights for the quarter. Now, the company reported 13 billion in new NVIDIA GB300, B300 orders, and they raised guidance to $36 billion, which is fantastic. They also are positioning their DC BBS data center building block solution as a strategic higher margin offering that has begun shipping already, and it's key for data centers going forward. Now, on the downside, their Q1 revenue miss on guidance, 5 billion, with 1.5 billion shipments pushed into Q2. That's not good for this quarter, but hey, that moves into next quarter, which is going to help. And it's not gone. It's just moving and shifting to next quarter. So that will help there. Now, management did warn of near-term margin pressure. They expect a slight decline due to mega cluster ramps, higher engineering cost, and customer-specific low-margin deployments. I don't really like the sound of that. It kind of sounds like excuses to me. But regardless, I think Supermicro is going to do great moving forward, and it's on sale right now. So the main reasons for the sell-off was gross margin compression. Input cost and logistics are eating into their profits. They had inventory that they were stuck with and didn't ship out, but good news is that's moving out to next quarter. Wall Street also expected that EPS beat, and instead they got a margin warning. So the reasons to be long right now and why I'm long with the stock on sale, well, number one, they delivered impressive revenue growth of 46% in 2025, driven by their leadership in the AI enterprise server solutions. The company's known for fast time to market. So when these data centers rolled out, they need product fast. That's what Supermicro does. Now, ELF Beauty actually surprised a lot of people because they beat on EPS, but they missed on revenue, and the stock just sold off big. So for the quarter ended September 30th, the adjusted EPS came in at 68 cents versus 57 cents expected. So that's a 19% beat. Now, actual revenue was 343 million and 367 million was expected. So that's where they missed. Now, for the full year, ELF now expects 1.55 to 1.57 billion in net sales, and they're also guiding $2.80 to $2.85 EPS for the year versus the 3.58 that Wall Street expected. So their guidance was lower, and thus the reason for the drop. Now, keep in mind, ELF has posted 27 consecutive quarters of sales growth, which is incredible. And they're still expanding market share across drugstores and Target shelves. And the Rhode acquisition, Hailey Bieber's brand, is starting to contribute to the skin care sales going forward. That's going to be huge. Now, what really spooked investors was the higher tariff costs. However, they have raised their price across the board by $1, which helps with that cost. But roughly 50 million in headwinds is what they were talking about, plus softer consumer spending guidance. So that's not good either, but I think that's all going to come around. Now, as far as the key takeaways from the earnings, well, they grew Q2 net sales 14% to $344 million and 18 to 20% net sales growth, which is fantastic. The Road acquisition contributed $52 million, and going forward, they expect $200 million in FY 2026. Now, on the negative side, those tariff headwinds with who knows what's going to happen with these negotiations and where that ends up. But I think it's in both China and the U.S. best interest to work something out. So I think it's going to be okay. So earnings certainly weren't perfect for either company, but I'm not worried long term. Long term, here's why I'm bullish. SMCI isn't a hype stock. It's the backbone of AI infrastructure. Every AI model, every data center, every cloud expansion needs physical servers, and that's what SMCI does. They've got deep partnerships with NVIDIA and AMD, and they can customize hardware for AI training and inference far more efficiently than traditional OEMs. So while Wall Street is obsessed with short-term EPS misses, I'm looking at the $36 billion guidance number and seeing a massive runway. Now, ELF is a very different company, but the logic is similar. They missed on guidance because they're reinvesting in growth and absorbing tariffs. That's short-term pain for long-term gain. They're dominating Gen Z and millennial consumers with affordable luxury, the sweet spot between drugstore and premium. Plus, the Road acquisition opens up new skincare lines and influencer marketing synergy. If we zoom out, the brand has grown sales every single quarter for over 6 years. That's not a fluke. The valuation is still reasonable for a 20% top-line grower. So just like SMCI, it's not broken. It's just bent by short-term expectations. So here's how I'm playing both of these stocks. Now, I'm not chasing the dip blindly. So for SMCI, as long as guidance holds and AI server demand stays hot, I see this as a core AI infrastructure play into 2026 and beyond. For ELF, the stock is back to levels we haven't seen in months, and this company is still growing double digits. I'm buying gradually because it may take a few quarters for tariffs to stabilize and the Road integration to show results. So let's jump on the platform and I'll show you the trades. All right, guys, this is the Tasty Trade trading platform and brokerage. My favorite for trading options. There's a link down below and benefits if you go through my link. We're going to look at ELF first, and we punch in ELF in the upper left right here. You can see I've got some leaps on right now. Let's go to the trade page, and I'm going to open up the June 2026 223 DTE, days to expiration. I'm going to go right at the money, $70. We're going to click on the buy to buy that. $15.55 is the price. Now let's go out a time frame, and it's 21, so we don't want to go there. The best price, I like that $15.55 or $14.45 at 189, but no, I'm going to go 223 days, $15.55 right here in the middle. Now what we're going to do is close that up. You can see, go to curve mode and analysis. Just like owning the stock, I've got other positions on right now. So, but you can see as the stock price increases, the option contract increases in value. So that's the whole point of utilizing the option. One option contract controls 100 shares of stock. So $15.55 times 100, $1,555 versus controlling or buying 100 shares outright. It would be $70 times 100 shares, or $7,000. So significantly less. Now we're going to go to the table mode again, close that up, go out to December. Now we can sell the 80 call. It's down to 70 right now. I can sell the 80 and collect $2.82. So $282. That's a good play right now. that brings the cost down to $12.66. So it brings it down by $2.81 or $281. So I'm going to go ahead, hit review and send, and place that trade. Looks like we need to adjust it just a little. 1275. There we go. Filled. All right, and for Super Micro, I'm going to do the exact same trade, the poor man's covered call. I'm going to go out to December, open that up. I'm going to go right at the money, the 38 for $12.95. We'll buy that, close it up, and then we'll sell a short-term call against it in December, and we can sell that. I can go out here to the 44 for $1.84, and we reduce that price by $1.84, and now the price is $10.96. So I'm gonna move it up, bump it up. I'm gonna go clean at $11. Hit review and send, and we're filled. Now keep in mind, with those poor man covered calls, you collect that short-term premium. You can do that every single month. So if you collect $200-300 a month, you can pay off the cost of the leaps in usually less than 6 months, and then you control those 100 shares for free. So to wrap up, both SMCI and ELF got punished after earnings. But hey, I don't buy when things are great. I buy when there's short-term pullbacks in good long-term stocks, which is the case with both ELF and SMCI. Be sure to comment down below. Let me know, are you buying these stocks? What are you doing? And leave a comment, ask a question. I answer everyone. Be sure to like and subscribe and join the Discord. It's free right now, won't always be, but there's a link down below and you can see all my trades and weekly setups. If you like this video, watch this next one.